all-inclusive trips and holidays, my Netflix accounts, my Spotify.
It's U.S. gift cards. Our response team has spent the past few months investigating the scam.
They A, bought a card with money on it stolen from someone else's account, and B, they basically just helped a crook launder the money on that card.
Every year, trillions of dollars of dirty money flow through hidden channels. Criminals use secret shell companies, digital currencies, and clever tricks to clean their cash, often right under our noses. Today, we're breaking down the most ingenious money laundering tactics you've never heard of. Chapter 1. The hidden world of money laundering. Money laundering is the process criminals use to make illegally obtained money appear legitimate, allowing them to use it without raising suspicion. It happens in 3 key stages: placement, layering, and integration, each with its role in disguising the origin of dirty money. The first stage, placement, is where the illicit funds enter the financial system. This is the riskiest step for criminals because large cash deposits often trigger alarms. To avoid detection, they break large sums into smaller amounts, a tactic known as smurfing, and deposit these into banks or use cash-intensive businesses like casinos or restaurants. Other methods include buying foreign currency, false invoicing, or purchasing assets like securities or insurance with cash. The goal here is to blend dirty money with legitimate funds without attracting attention. Once the money is inside the system, criminals move to the second stage, layering. This involves a series of complex financial transactions designed to confuse the trial and hide the money's criminal origins. Funds might be transferred between multiple bank accounts, often across different countries, or converted between currencies, including cryptocurrencies. Criminals use fake invoices, shell companies, and trade-based schemes to add layers of complexity. The more layers created, the harder it becomes for investigators to trace the money back to its source. Offshore jurisdictions with lax regulations often serve as safe havens during this stage. The final stage is integration, where laundered money is reintroduced into the economy as apparently clean assets. Criminals might buy luxury real estate, invest in stocks or bonds, or claim gambling winnings. Sometimes they create fake business income or use loan repayments from companies they control. At this point, the money looks legitimate and can be freely used without suspicion. Why does this matter? According to the United Nations, up to 5% of the world's gross domestic product, roughly $2 trillion, is laundered every year. In the United States alone, banks file about 2 million suspicious activity reports annually. This massive flow of illicit money fuels organized crime, corruption, and economic instability worldwide. Understanding these stages is crucial because each presents unique challenges for law enforcement and financial institutions. It also shows why money laundering is so difficult to detect and why criminals constantly adopt their tactics to stay one step ahead. Chapter 2. Common money laundering tactics. Let's get into the real deal. How do criminals clean their dirty money? The tricks they use are clever, sometimes sneaky, and always evolving. Here's a breakdown of the biggest money laundering tactics you need to know. Smurfing, or structuring. First up is smurfing, sometimes called structuring. Think about having a suitcase stuffed with illegal cash. You can't just walk into a bank and deposit it all at once. That's a guaranteed red flag. So what do? You break that huge sum into smaller chunks, usually just under the bank's reporting threshold, which is often $10,000. Then you spread those deposits across multiple accounts, branches, or even banks. But here's the twist. Criminals don't do this alone. They recruit a network of people, called Smurfs, to make these small deposits for them. It's like flooding the financial system with tiny drops of dirty money, making it almost invisible. Banks see a lot of small deposits all over the place, but none large enough to trigger suspicion. This tactic exploits the limits of financial monitoring systems designed to catch big transactions, but often miss the many small ones. Layering. Once the money is safely inside the financial system, criminals move to the next phase, layering. Think of layering as a smokescreen designed to confuse and mislead investigators. The goal is simple: to make the money's origin impossible to trace. How do they do this? By moving funds through a maze of transactions. Money might be transferred between multiple bank accounts, sometimes thousands of times, often crossing borders and currencies. Criminals use fake invoices, shell companies, and complex corporate structures to move money around. They might buy and sell assets like cars, art, or stocks repeatedly to create a confusing paper trail. The more layers they create, the harder it becomes for law enforcement to follow the money. Think of trying to untangle a giant knot. That's what investigators face when tracking laundered funds. Offshore accounts in secrecy-friendly countries are often used here, providing safe havens where money can be parked temporarily before moving on. Integration. After all that shuffling, money finally reaches the stage of integration. This is where dirty money is reintroduced into the economy as apparently clean cash. Criminals want their money to look like it came from perfectly legal sources. They do this by investing in real estate, luxury goods, or legitimate businesses. For example, buying a luxury apartment with laundered money and then selling it later makes the proceeds look like legitimate capital gains. Sometimes they funnel money through fake business income or claim gambling winnings. Loan repayments from companies they secretly control are another popular method. At this point, the money looks clean enough to be used openly, to buy cars, fund businesses, or even invest in the stock market without raising suspicion. Cash-intensive businesses. Now, let's talk about cash-intensive businesses. These are perfect covers because they naturally handle large volumes of cash, making it easier to blend illegal money with legitimate earnings. Restaurants, bars, car washes, and small retail shops are often used. Criminals might over-report daily sales to justify the extra cash they're putting into the business. For example, a restaurant might claim to have served twice as many customers as it did, making the extra cash appear as legitimate revenue. These businesses often look poorly managed or barely profitable because their real purpose isn't to make money, it's to launder money. The cash flows through them, gets deposited in banks, and suddenly, dirty money looks clean. Trade-based money laundering. One of the most sophisticated tactics is trade-based money laundering. This method exploits the complexity of international trade, which involves billions of dollars in goods moving across borders every day. Here, criminals manipulate the value or quantity of goods in trade documents. They might over-invoice exports, claiming a shipment is worth $10 million when it's really worth $5. This allows them to move extra money out of the country disguised as payment for goods. Alternatively, they might under-invoice imports, paying less than the actual value and moving illicit funds through the difference. Because global trade is so vast and customs rules vary widely, it's difficult for authorities to spot these discrepancies. Criminals use this loophole to move money across borders with little risk of detection. Black market peso exchange. The black market peso exchange is a clever laundering scheme mainly used between the United States and Colombia. Here's how it works. Drug traffickers in the US have large amounts of cash from illegal sales. Instead of physically moving the cash back to Colombia, which is risky, they sell it to black market brokers at a discount. These brokers then use the dollars to buy legitimate goods in the US, like electronics or appliances. The goods are shipped to Colombia, where local importers pay the brokers in Colombian pesos. The traffickers receive their money in local currency without the cash ever crossing borders. It's a parallel money system, one legal, one illegal, that keeps dirty money off the radar. Real estate laundering. Real estate is a favorite playground for money launderers. Why? Because properties are high value, and ownership can be hidden behind layers of companies and trusts. In real estate laundering, criminals buy luxury homes or commercial properties using illicit funds, often through shell companies to mask their identity. They might flip these properties, buying and selling them to themselves or associates to generate clean profits. Alternatively, they rent out properties, making rental income appear legitimate. Cities with booming luxury markets are hotspots for this tactic. The high prices and complex ownership structures make it easier to hide the true source of funds. Shell companies. Let's talk about shell companies, the ghosts of the business world. These companies exist only on paper with no real operations, employees, or offices. Criminals use shell companies to move money around, issue fake invoices, or hide who owns the money. They often register these companies in countries with lax regulations and strong secrecy laws. By creating a network of shell companies across different countries, criminals build a maze that's almost impossible for investigators to navigate. This makes it incredibly difficult to identify the real people behind the money. We've covered a lot already, but the world of money laundering is vast and full of surprises. Let's explore some more tactics that criminals use to keep their dirty money hidden and flowing. Bank complicity. Sometimes, the biggest obstacle to stopping money laundering isn't just the criminals, it's the banks themselves. Bank complicity happens when financial institutions, either knowingly or through negligence, help money launderers move illegal funds. Take, for example, the massive TD Bank scandal from 2024. For nearly a decade, TD Bank failed to properly monitor suspicious transactions. Criminal networks exploited these gaps, moving hundreds of millions of dollars through the bank's accounts. The result? TD Bank pleaded guilty and agreed to pay a staggering $3 billion in fines. This case highlights how even major banks can become unwitting, or worse, willing participants in laundering schemes. Banks are required by law to follow strict anti-money laundering procedures, but when those controls fail or are ignored, it opens the door for criminals. Corrupt employees, weak oversight, or a culture focused more on profits than compliance can all contribute to bank complicity. And when banks turn a blind eye, dirty money flows freely. Offshore accounts and tax havens. Next up, offshore accounts and tax havens. These are secretive jurisdictions like the Cayman Islands, Panama, or the British Virgin Islands, known for their strict privacy laws and minimal financial disclosure requirements. Criminals stash their money in these offshore accounts to hide both the cash and the true owners. Often, they use shell companies registered in these havens to add layers of secrecy. On paper, money looks like legitimate foreign investment or corporate funds, but it's just another way to keep illicit wealth out of sight. While using offshore accounts isn't illegal by itself, they're frequently abused for money laundering, tax evasion, and hiding assets from authorities. Secrecy makes it incredibly difficult for investigators to trace the money back to criminals. Cryptocurrency laundering. Cryptocurrency has changed the game in money laundering, and not always for the better. Many people think blockchain is fully transparent, but the reality is more complex. Criminals exploit the anonymity of crypto wallets. They use tools called mixers or tumblers that blend coins from many users to obscure the trail. For example, a criminal might convert Bitcoin into Monero, a privacy-focused coin, then back into Ethereum, hopping between chains to confuse investigators. Decentralized finance, or DeFi, and NFT wash trading have become new playgrounds for laundering. Criminals trade fake tokens, or NFTs, between wallets they control, creating the illusion of legitimate trading profits or art sales. This makes illicit funds appear clean. One notorious example is North Korea's Lazarus Group, which reportedly laundered over $100 million through Tornado Cash, a popular crypto mixer. Art and antiquities laundering. The art world might seem glamorous, but it's also a favorite laundering ground. The art and antiquities market is highly unregulated, with no official price registry or transparency. Here's how it works. Criminals buy expensive art, sometimes real masterpieces, sometimes fakes, with dirty money. Then, they inflate the appraised value, sometimes by 5 or 10 times the original price. Next, they sell the art to themselves or shell companies, creating a legitimate transaction. To hide the assets, they store the art in free ports, tax-free warehouses in places like Geneva, Singapore, or Luxembourg. These free ports allow valuables to be kept out of sight and out of reach of regulators. This method turns art into a portable, high-value asset that can be moved or sold discreetly, making it perfect for laundering. Casino laundering. Casinos handle huge volumes of cash daily, making them ideal for money laundering. Here's the basic playbook. A criminal buys chips with dirty cash, gambles a little, sometimes intentionally losing or making small bets, and then cashes out the chips as winnings. These winnings can be collected via check, wire transfer, or payout slip, giving the money a clean, legal paper trail. By using different aliases, visiting multiple casinos, or cashing out at different counters, launderers reduce suspicion. Casinos often struggle to detect these patterns, especially when cash flows are high and customer turnover is fast. Charity laundering. Not all charities are what they seem. Charity laundering involves setting up fake nonprofits with noble-sounding names. Criminals funnel dirty money into these charities as donations, then disperse the funds to front companies or fake projects. Sometimes, real charities are hijacked by insiders who divert donations for illegal purposes. This not only launders money, but also damages the reputation of genuine charitable organizations. Besides cleaning the money, charity laundering can provide tax deductions and build public credibility, making it a tempting tactic for criminals. Prepaid and gift card laundering. Prepaid gift cards might look innocent, but they're a favorite tool for laundering money. Criminals buy hundreds of these cards in small amounts to avoid raising suspicion. No ID needed, no bank link. Then, they use the cards to buy expensive items like smartphones or luxury goods, which they resell for clean cash. Sometimes, they purchase from fake online stores they control, moving money into seemingly legitimate businesses. Others slowly transfer funds into cryptocurrencies or online gambling, making the money even harder to trace. In 2020, authorities busted a huge ring that moved $10 million this way, buying goods shipped overseas to hide their tracks. It's a clever, low-risk method that keeps dirty money flowing under the radar. Loan back and fake debt schemes. Finally, let's talk about loan back and fake debt schemes, which are clever ways to make dirty money look like legitimate income. Here's how it works. Criminals set up two companies, often in different countries. One company loans money to the other, controlled by the same person or group. The loan is fake, but the money flows from one entity to the other, appearing as a legitimate repayment. To complicate things further, they might involve shell companies in tax havens like the British Virgin Islands, banks in Cyprus, or consulting firms in Dubai. The repayments are reported as income, deposited into bank accounts, and reinvested, completing the laundering cycle. These tactics show just how creative and resourceful criminals are when it comes to hiding illicit funds. Each method exploits loopholes in financial systems, regulatory gaps, or new technologies. Chapter 3. Crypto and AI. Cryptocurrency has flipped the money laundering game on its head. Unlike cash, crypto moves fast, crosses borders instantly, and offers a level of anonymity that criminals crave. But how exactly do they hide dirty money in this digital world? One popular trick is using mixers or tumblers. Think of these like blenders for crypto. They mix your coins with thousands of others, making it impossible to trace where the money originally came from. It's like pouring different colored water into a big tank and then drawing out a new color. This breaks the trail and hides illicit funds. Then there's chain hopping. Criminals jump between cryptocurrencies, swapping Bitcoin for Tether, then for Monero, and back again. Each jump adds confusion and layers of complexity, making it harder for investigators to follow the money. Artificial intelligence is a double-edged sword here. Criminals use AI to automate laundering, moving money quickly across platforms without human error. But regulators fight back with AI-powered tools that spot suspicious patterns faster and more accurately than ever. It's a high-tech cat-and-mouse game shaping the future of financial crime. Chapter 4. Global hotspots and regulatory battles. Money laundering is a worldwide problem, but some countries and regions stand out as major hotspots. The United States, China, Russia, and Mexico top the list, with billions of dollars flowing through their financial systems every year. These countries face unique challenges, from vast underground economies to complex criminal networks. Regulators are stepping up their game. In 2024, a major U.S. bank was slapped with a record fine of over $1 billion for failing to detect and prevent money laundering. This sends a strong message. No institution is too big to be held accountable. Around the globe, governments are investing heavily in anti-money laundering technology. The AML software market is booming and expected to reach multi-billion-dollar valuations by 2025. These tools use artificial intelligence and big data to spot suspicious transactions faster and more accurately than ever before. But even with these efforts, enforcement remains a huge challenge. Criminals exploit gaps between countries' laws, moving money through complex corporate structures and offshore accounts. International cooperation is essential, but it's often slow and complicated. Even with billions in fines and thousands of arrests, law enforcement recovers less than 1% of illicit funds worldwide. The scale of the problem is staggering, and the fight is far from over. Chapter 5. The future of money. Laundering and prevention. Looking ahead, money laundering will continue to evolve alongside technology. Virtual assets, decentralized finance, and AI-driven schemes will test regulators and financial institutions like never before. But the future isn't all bleak. Advances in AI-powered transaction monitoring and real-time analytics are transforming how suspicious activity is detected. Financial institutions are becoming more proactive, using sophisticated tools to stop laundering before it spreads. Global cooperation is improving, with countries sharing data and strategies more effectively. The fight against money laundering is a marathon, not a sprint. With vigilance, innovation, and collaboration, the financial world can become a much tougher place for criminals to hide their dirty money. Money laundering is a constantly evolving challenge where criminals adapt quickly to new technologies and loopholes. Yet, each innovation in laundering methods drives regulators and financial institutions to become smarter and more vigilant. The fight is complex and global, but understanding these tactics is essential to making the financial system more resilient and secure. Thanks for watching.